What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over SPY and we're going to talk about some stocks that we're watching for the month of February. We're going to give you all the price targets and support points that you're going to need to trade these stocks, so make sure you follow along and set those levels on your charts. So first, let's talk about SPY and the overall state of the market. Remember, we always like to cover SPY because SPY is the S&P 500 ETF. Therefore, the general direction of SPY is going to give us the general direction of the market. Now, if you've been following the markets for the last 4 months, you know that SPY has not made a lower low. In fact, our lowest low was 348 in the last 52 weeks. So many people are now wondering, is this recession ever going to cause a crash? Or why are we going up when we're supposed to be in a recession? Something to keep in mind is that the stock market and the current state of the economy don't always move in perfect correlation. Historically speaking, the stock market has a tendency of preparing itself for a recession months or even years ahead by experiencing a correction ahead of the time in which the economy is contracting rather than expanding. So with that being said, what we experienced in 2022 was just part of our normal 2-year cycle. So every 2 years, we do see the market slide an average of 14%. So we actually beat that average in 2022 when the markets came down as much as 20%. This is the first real correction we've seen since the COVID crash of 2020. And so with that being said, this is actually a good sign for long-term investors, because if we had kept going, that means the correction would have been much more severe. But the fact that we came down and prepared ourselves for a potential contracting economy means that markets prepared themselves in a right way. If markets had come down straight down, we could have called that a crash and we could have blamed that on the recession. So the next question is, are we going to make a lower low and are we ever going to come back down? And the answer is yes, we are going to come back down, but we don't expect to make a lower low unless the recession gets worse. So if the situation in the economy gets worse and we see some unfolding events that may be detrimental, then we do expect the market and SPY to move to a low of 320 to 325. But if that doesn't happen, then we do only expect the market to move back towards 350 to 360, and then we'll likely see a bottoming out and move back to an all-time high once again. All-time highs are a bit of a reach, but it doesn't mean that they're impossible in 2023. We don't expect us to hit new all-time highs in 2023, but anything can happen and we'll play it accordingly. So now let's switch gears and talk about the short-term outlook for what's happening in the markets. So if you are a short-term trader or a swing trader or a day trader, you're probably wondering what's going to happen in the next few days to few weeks. First of all, you have to recognize that the market has been rallying for over a month, and we just got hit of a wave of earnings in which large cap tech missed on revenue and earnings per share. We saw earnings miss from Apple, Amazon, Google, and these companies hold a lot of weight in the market. And although they missed earnings, we saw markets still rocket higher, and many people are wondering, where is this pullback going to happen? If you are watching the short-term charts on SPY, you know that 410 is a very strong resistance level that we successfully broke above last week. So with that being said, the market is looking for a hold above that 410 support. If we move below 410, then we can expect ourselves to begin filling the gap back down to 400. So all the people that bought up the market above 400, if they see it move back below 410, which is a very significant resistance that we broke above, then they're going to want to take profits, and we're going to see the market moving back towards 400. If we break below 400, that is a very significant level to break. That is because we spent about 5 days consolidating above 400 before breaking out into this rally. So all the buyers that bought it up above 400 for those 5 days will be willing to let go of their position, and if they break 400, that means the market can fall to a low of 387. And so our next target, if we break below 400, is going to be around 387 to 388. So if you're looking to play short or you're looking to play puts, you need that break below 400 for the bears to really take over. Now, many people will say that the market may be overbought or oversold at certain points, but the truth is, no matter how overbought the market is, it doesn't mean that it will stop rallying. The market can be irrational for much longer than you think, and so if it keeps going up, you want to know where it's going next. So let's talk about the breakout points. SPY will need to break above 418.30 in order for it to move to its next price target of around 421. If we break above 421, which is this gap fill from around August of last year, then we can potentially see SPY move towards 425 to 430. So remember, above 410, the people who shorted the market are starting to buy back to close their positions. And if they continue to buy back, then this short rally, it's called a short squeeze rally, will continue moving up, and you don't want to miss out on these opportunities. So don't play what you think will happen. Don't listen to what people are saying about overbought and oversold. You have to just simply play the levels that you're given and play them accordingly. So we've talked about SPY's technical analysis, we've talked about the overall state of the market. Now it's time to talk about the watch list. So what stocks are we watching for the month of February? We're going to start off with American Express, which is experiencing something called a power earnings gap up. During earnings season, you're going to see a lot of stocks either gap up or gap down. Now, when a stock gaps up on earnings, we always like to add it to our watch list because that's a stock that has more upside potential. We can see with the Nike example here that the stock gapped up and it continued rallying for the months to come. So we're expecting the same thing to potentially happen to American Express. In fact, we have an entire power earnings gap up strategy video that we're going to leave in the description. It's free, it's on our YouTube channel. It's definitely worth watching because it's the best strategy to apply during earnings. So if you are watching American Express with us and you're looking to trade it, here are some levels that we're focused on for the weeks ahead. American Express gapped up, and the lowest point of that gap up was around 165. Therefore, that is the strongest support that we have for it in the coming weeks. If you are looking to trade the stock in a bullish trend, you can take on the stock anywhere above 170.60 and use a stop loss just below that level. If the stock comes around to break above 180.40, then your first price target is going to be around 183 to 184. Now, if you are bearish on the stock and you're looking to play puts or a short position, then you can break below 170.60 in order for a move to 165 to 167. Keep in mind that American Express's lowest point was 165. And so if we break below that level, then we can expect the selling to accelerate and begin filling that gap down towards 158 to 160. The next stock on our watch list is a familiar favorite. It goes by the name of Tesla, and we can see that Tesla has accomplished something phenomenal in the last 4 weeks. Tesla has nearly doubled in just a matter of a month, and it's testing a line in which it hasn't tested since September of last year. Tesla is currently trading right below its 100-day moving average, and so if you are a trader and you're looking for an easy line to follow, you can look at this 100-day moving average, and if you're looking for a bullish trend, you're going to need the stock to maintain a level above it, which you can see it's gotten rejected at it twice at the time of this video. When the stock is trading above that level, then you can expect the stock to continue a bullish trend and potentially move towards the 200-day moving average right around 225 to 230. If you are bearish on the stock, you're going to need the stock to maintain a level below the 100-day moving average for it to potentially turn back down and move towards 160 to 167. Now keep in mind, these are on the daily candles, which means they are longer term projections. Now let's focus on what's happening for the short term. When we're looking at Tesla's short-term charts, we can see that the stock is giving us very easy levels to trade off. Tesla got rejected at 199 in recent development, which means that the first breakout point is going to be 199 or right around 200. Remember, 200 is a strong number, which means it will naturally act as a resistance point. So bulls are looking for a break above 200 to move the stock towards a price target of around 208. If the stock breaks above 208, we do expect a short squeeze rally that will take the stock very quickly towards 220 to 225. Now, if you are bearish on the stock, you're going to need it to break below 183 in order to move to a price target of around 165 to 175 on the short term. Now, before we move on to our next stock, something to keep in mind with Tesla is that this is a level in which the stock accelerated its selling after breaking below. So we can see that Tesla, after breaking the level of 200, had attempted to get back above it not once but twice, which created a double top pattern that sent the stock to be cut in half. And so the fact that it's retesting that level makes that level a very pivotal point. Once the stock is back above 200, it can very much see a very strong upside rally that takes it much higher. So keep 200 in mind as a very strong level for Tesla. Now, moving on to the next stock on our watch list, it's going to be Chevron. Now, ironically, oil companies have started moving lower after a very strong earnings season. And that's likely because this is the time of year that we are starting to see gas prices kind of level out because there's not much traveling goes on and there's not much summertime activities going on. So not a lot of road trips, not a lot of people driving, therefore prices of gas typically do come down around this time of year. And so when we're looking at Chevron, we can play it to both sides, but we're mostly focused on the downside. Now, if you're looking to trade Chevron with us, these are the levels to focus on. First, if you are bullish on the stock, we're going to focus on the 171.50 level. 171.50 is a pivotal point. If the stock can get back above that level, then it can easily move towards 174 to 175. And as long as it holds 171.50, it can move higher, but we do like to take profits right around 174 to 175. If you are bearish on the stock, then you're looking for a move below 166.80 in order for the stock to move towards these price targets down here. The final two stocks on our watch list are going to be Boeing and United Airlines. We're not going to get into the details of those stocks, but we are going to leave you a link in our description in which you can join us for a 7-day trial where we send daily alerts. So I'll leave you guys with this, and I hope you guys enjoyed this video. Best of luck. Don't forget to subscribe and give us that thumbs up.